All right, here we are with chapter 13. We have three problems that we'll do videos for. So I'll have three different videos for chapter 13 problems. This one's a fairly quick one. This is issuing stated value common stock. So we'll have some paid and capital of excess of the stated value to calculate. That'll be our plug for the difference. And you'll see what we're doing shortly. So we have a little bit of math, easy math to do. The corporation issued 9,000 shares of $3 stated value of stock for $11 per share on July 7th. And they want you to record the stock issuance. So accounting for stated value stock is similar to accounting for par value stock. We have 9,000 shares and it was $11 per share. So this is how much cash the company is getting, Archer Corporation, for issuing their shares. So $11 per share, so 9,000 shares. So that is 99, right? 11 times 9,000. So $99,000. Let's put a dollar sign for the cash being received. Cash received. All right. And then we have, well, let's fix that to make that be, we'll just do an enter. And then we have to figure out the common stock's actual stated value. Well, in this case, I think in your like PowerPoint or the book, they use $1 stated value. Well, in this case, it is a $3 stated value. So don't get tricked up there. So we'll go ahead and multiply by 3. And so that is 29 times 3 is 27. So we have 27,000 for the stated value of the common stock. So don't get tricked, because in the book it might have had $1 instead, and so just don't get tricked that that's the 3. That's where that's coming. That's the value of the common stock. Okay, so let's go ahead and do our journal entry. We have July 7th, so let's put the date in. Be proper about that. And the cash received will be our debit. So we'll go ahead and record that if it will tab over. Okay. And then that was the 99,000. That was cash received. All right. That's easy enough. And then now we have the common stock at $3. Okay. So let's write that down. Let's write this as just a reminder. All right. And so that was the 27,000. So the common stock's normal balance is a credit. That makes sense. And we're out of balance. Our debits and credits don't equal. So this is where I called, hey, this is our plug. Well, that's the paid in capital in excess. Oops. Come on. Way too many dashes there. Of stated value. All right, and that would be the difference of 99,000 minus 27,000, so that is 72. So you could have done, you could have said, oh, you know what, I want to check the math for that. So fine, you could have done the excess of it. So it would have been, you know, $11 minus 3, right? And you could have done it this way. And it's pausing on me. And you would have gotten $8, right? That was the excess that was received per share. Yeah. And then you could have multiplied that $8 times the 9,000 shares. And then you would have gotten the 8 times 9 is 72. So yes, you could have done it that way. But we know, hopefully by now, we know that debits and credits need to equal. And so we could have just plugged the difference, but maybe double check. And so that's your double checking. So just remember that the plug is the difference between the $11 per share and the stated value. And in this case, that was $3 per share for the stated value. So that is real quick. That is the first problem. Pretty easy, and we'll finish up with another video for problem 2.